If you delayed Social Security to get a bigger check anytime in the past 15 years, you might be regretting it today. And if you don't feel like you regret it even just a little bit, or you don't understand why someone would say that, it probably means you haven't seen the surprising math behind claiming Social Security early. And that's exactly why in this video, we're going to be revealing some eye-opening statistics about claiming Social Security early, especially since you're constantly told that the responsible move is to wait. But here's what almost no one explains clearly. Yes, waiting gives you a bigger check later, but that's only one part of the story. So today I'm going to be breaking this down in a simple and practical way. We're going to be looking at a 15-year back test of claiming early versus delaying. We're going to look at the surprising math most people never see, why a bigger benefit later logic can be misleading, and stick around to the end because we're going to reveal a flip it on its head moment and discuss why delaying actually becomes a smarter move for some people. Once you see these actual numbers, the decision may become a lot clearer for you. My name is Joe Bogan. I'm a certified financial planner, and I have reviewed hundreds of retirement plans and Social Security claiming strategies. This video is not advice. It's educational content completely for free to help you make better financial decisions. Now, before we actually look at the back test, let's discuss why some people, regardless of investments, are going to be better off if they claim early. And that's just because a lot of people are not going to live long enough to break even on their benefits, regardless of their investments. If you defer Social Security, you have no payment for years. Then when you do claim with a higher payment, it typically takes 11 years to make up for those missed years with the higher payments that you're getting later. But according to a study published in the Journal of Financial Planning titled, "It May Be a Mistake to Delay Social Security Retirement Benefits," for people that are 67 today, 49% of men will not live till their break-even age, and 36% of women will not reach their break-even age at approximately 82 if they defer claiming till 70. Second, and maybe more importantly, it's the impact on your retirement portfolio by delaying your Social Security benefits. The average retiree in their 60s, at least a couple $100,000 saved in 401ks, IRAs, or mutual funds. Many people have over $1 million invested. And for anyone with real retirement savings, this traditional advice to defer and get a bigger check later is way too simple for a few reasons. Because if you're spending your portfolio down to defer Social Security for a higher benefit later, your portfolio could have been growing if you took Social Security early. So we really need to take care to consider both of these scenarios and evaluate what's the best. We have to look at the whole picture, both the payment, but also the effect on things like investments and taxes and estate planning. And this can be a complex point to really grasp. So to make it easier, what we've done is we took a back-tested scenario 15 years ago in 2010 roughly. What would have happened if you retired, if you're 62, let's just say, for someone who has $1 million saved and invested going into retirement in 2010, then they're eligible for benefits. They need to spend about $60,000 per year from their portfolio, and they're going to want to increase that every year with inflation. So we're going to assume that they're invested in a basic 60% stock, 40% bond portfolio, and we're going to simulate what the past 15 years would have been like if they delayed versus claiming now. If you claimed at 62 in 2010 or waited till 67 or 70, you're getting a smaller benefit early, but you also left more of your investment portfolio in the market. What would have happened in those years? Well, you can see this person who claims 62 is significantly outperforming. Their portfolio is roughly $350,000 more compared to the person in the defer to 70 scenario, and is roughly $220,000 more than the person who claimed at 67. Well, the payment from Social Security is substantially larger for someone who deferred. This individual is 77 at this point, and they will continue to see the effect of compounding on their portfolio. So if they get 7% next year, that is going to be worth more to the person who is 62 because their nest egg is larger. So unless their portfolio stalls, the larger payments are going to have a significant uphill climb to break even at this point compared to the claim early scenario. It's important to note these are pre-tax figures. Taxes are relevant here, but they're going to be different for every single person. But even so, as you can see, the actual impact on the portfolio is quite significant and worth noting. Now, does this mean that you should base your entire claiming decision based on what happened in the past decade? I would say no, probably not. But this is information, and it's very relevant and potentially helpful information to consider. And the traditional advice does not reflect the realities of an investment environment. Here's the problem. Most advisors are using these break-even charts, which basically assume a 0% return projecting on their portfolio. Or even if they're not doing that, they may be using overly conservative projections because nobody can guarantee returns, even if they feel like it will be likely to assume in their scenario. But real investors live in real markets, not in projections. So what is the appropriate rate of return to consider for someone who is trying to make a Social Security decision in this environment? And that leads us to point 3. That's considering the opportunity cost. So we've established that break-even charts and traditional advice is horribly flawed, but that doesn't tell us about how to think about this environment and the future. Hindsight is always 20/20. What returns would be wise to project in today's environment for the average retirees thinking about what they need to do to make the best of their nest egg? Here's the problem. No retiree is average, but we will draw some broad generalities to better understand the impact on your personal wealth in this whole situation. This involves understanding a concept in economics known as opportunity cost. It's one of the most important concepts. And in fact, as Charlie Munger, one of the greatest investors of our time and Warren Buffett's longtime partner, famously stated, all intelligent people should think primarily in terms of opportunity costs. When deciding whether to do something, you need to really compare it with the best alternative opportunity that you have. In our case, the opportunity cost of deferring Social Security is spending down your portfolio to meet your needs, and you'll miss out on the potential rate of return you could have realized by claiming Social Security early and staying more invested. The greater you assume your returns are going to be, the less attractive it is to defer your Social Security. That's a higher opportunity cost. If you have a lower opportunity cost, that means you have lower expected returns, and it's more attractive to delay Social Security and spend more of your portfolio earlier. But the markets are going to move, your investments are going to fluctuate, so we have to think of what a rational assumption would be for the future. Taking long-term averages and anticipated future returns prudently is more sensible than using recent history. According to the study in the Journal of Financial Planning, researchers show a 4% real rate of return. After taxes are assumed and after inflation is assumed, a person has to live to about 89 for it to be beneficial for them to delay their benefits. Here's the problem. 77% of males are going to die before that break even, and 65% of females are likely to die before that break even age. Age 70 may not be the most financially rewarding age to initiate benefits unless you have a low expected return rate and or are confident that you're going to need benefits past the normal life expectancy. So some advisors are going to argue that it's more important to be conservative and use a lower rate of return and maybe delay claiming. But on the other hand, depending on the situation, some may suggest using a prudent but still larger opportunity cost rate of return, which may suggest claiming early. The key here is to use the right framework and not just rely on the bigger benefit later logic. We need to really compare deferring with the next available alternative, not just a flat chart with some missing variables. Now, I'm going to reveal the next point, and this is a big one, which a lot of people do not consider. But if you're trying to figure out, should you claim when you retire? When should you claim? And you want some personal feedback, I want you to click into the link in the description with the retirement quiz. If you fill it out, we will send you a completely free 5-minute video walking through your unique situation. Now, let's talk about a fourth point, which is a very significant variable in this whole equation, and that's the sequence of returns risk. Sequence of returns risk simply means that the order of your returns matter. So you're going to have good years, you're going to have bad years, but if you have a bad year at the wrong time, that can significantly derail your retirement portfolio. To understand this, imagine your retirement like planting a young tree. If the first few years bring calm weather, the roots are going to grow deep, the trunk is going to thicken, and the tree is going to become very resilient to any storms. But if a storm hits early before those roots are fully formed, that young tree can be uprooted or maybe significantly damaged. Your retirement portfolio, when you retire, works in a similar way. You delayed Social Securities, the market crashes early, even if it recovers later, you have to withdraw heavily while it's down early. You have to rely on selling your portfolio more. It's going to be harder to recover. So basically, drawing aggressively from your investments in those first few years magnifies the potential sequence of returns risk, because the damage in a bad market environment could be a lot greater, increasing stress, and you may be in a position where you're feeling more fear. Claiming Social Security earlier, on the other hand, with regard to sequence of returns risk, can really reduce the pressure and vulnerability of your portfolio in those early years. It's going to help you preserve that principal, it's going to smooth your withdrawal rate, and it's going to help your portfolio to set its roots before facing the potential storms that will inevitably occur in markets. Now, lastly, let's flip this all on its head. And this is understanding the safety first approach. Because for some people, delaying Social Security is in fact a smarter move. And why could that be? The safety first philosophy relies on the idea that covering your essential expenses with guaranteed income, so you're not relying on the market to meet your basic needs. So for many retirees, delaying Social Security is going to increase that guaranteed income floor. This means it raises their worst case scenario up without buying expensive products like annuities or shifting heavily into bonds. Most retirees don't want or can't handle high investment risk as they get older and into retirement. And at the same time, even though this may not lead to the optimal wealth creation path, if markets are doing well, they may end up with significantly less wealth in the best case scenario. But at the expense of their comfort, that may not be a worthwhile trade, because they prefer to have a better worst case scenario and a greater sense of security when going into those later years of retirement. So if you want to build more safety into your future income, delaying Social Security may be the most cost-effective way to build that safety into your plan later on down the road, especially if you have longevity in your family or you have a younger spouse or a spouse with longevity. And this is where personal context is really going to matter. You have to look at real return history, what you expect, what's your comfort level with risk, what's your age and your spouse's age, your health, and your tax situation, because this is one often hugely overlooked variable. Taxes alone can tip the decision in one direction or the other, especially if you're on the fence. Today, we walk through how the last decade complicates traditional retirement claiming advice. We looked at the break-even charts and what they leave out as far as really critical financial planning variables. We talked about how sequence of returns risk can really threaten retirement planning and retirement portfolios. And we discuss how the safety-first philosophy works in the context of retirement planning and how that can affect someone's Social Security decision. Social Security is always about waiting. It's about knowing and making informed decisions and making smart trade-offs that are best for your situation. If you want a completely free 5-minute mini review on your financial planning or Social Security claiming decisions, click the link in the description. It's only available for a limited time, and thanks for watching. I'll see you in the next video.